Costco made $250 billion last year. $250 billion. That is more money than the GDP of Finland, Portugal, or New Zealand. It is more than Nike, Starbucks, McDonald's, and Netflix combined. And after all of that, after selling everything from a $1.50 hot dog to a $6,000 diamond ring, Costco kept about 3 cents of every dollar, 3%. That is not a typo. That is the actual net profit margin of one of the most successful retail operations in human history. Now, here is the question nobody seems to ask. If Costco barely makes money selling you things, where does the money actually come from? Because they are not losing money. Costco made $7.4 billion in net profit last year. That is more than most countries spend on their entire military budget. They are doing extremely well. They are just doing it in a way that has nothing to do with the $600 of groceries you just loaded into your car. Here is what most people think is happening when they shop at Costco. Costco buys things in enormous quantities. Because they buy so much, they get better prices from suppliers. They pass those savings on to you. You buy in bulk. Everyone wins. Costco profits. The end. That explanation is not wrong, exactly, but it is the equivalent of explaining how a casino works by saying, people come in and play games. Technically accurate, completely misses the point. The real Costco model is built on a principle that sounds obvious once you hear it, but that almost no other company has successfully copied in 40 years of trying. Make almost nothing on what you sell. Make everything on the right to buy it. Let's talk numbers, because the numbers are where this gets genuinely strange. In Costco's fiscal years 2024, they collected $4.8 billion in membership fees. Not from selling food, not from electronics or furniture, or the inexplicable 40-pound bag of rice that somehow ends up in everyone's cart. Just from charging people for the right to walk through the door. $4.8 billion. Now here's the number that changes how you see the entire company. Costco's total net income that same year was $7.4 billion. So membership fees, which represent less than 2% of total revenue, are responsible for somewhere between 65 and 73% of total profit. Read that again. Less than 2% of the money coming in generates more than 65% of the profit. The other $245 billion in merchandise sales, that operation runs at roughly a 3% margin, which, after you subtract operating costs, basically rounds to not much. Costco is not really a retail company that sells memberships on the side. It is a membership company that operates a retail store to justify charging you for the membership. The warehouse is the product. What's inside it is the advertisement. Now, and this is the part that should keep traditional retailers awake at night, the membership model does something that normal retail cannot do. It creates loyalty that is mathematically rational. If you pay $65 a year for a Gold Star membership, you are now financially motivated to shop at Costco, enough to justify that $65. You have skin in the game. You are not a customer browsing between options. You are an investor trying to get your money's worth. This is why Costco's renewal rate in the United States and Canada is 92.9%. That number is not normal. Subscription businesses are thrilled when they hit 80%. Netflix struggles to stay above 85%. Spotify spends billions on podcast deals trying to hold subscribers. Gym memberships famously survive on people who pay and never show up. Costco has 137 million cardholders, nearly 93% of whom pay again every single year. Not because they forgot, not because they can't find the cancel button, because they spent the last 12 months buying enough rotisserie chicken and toilet paper to feel like they came out ahead. The subscription model also does something that Wall Street loves even more than loyalty. It makes revenue predictable. When Costco raises membership fees, which they did in September 2024, from $60 to $65 for a basic membership, the additional revenue flows almost entirely to the bottom line. Analysts estimated that single price increase added roughly $290 million to operating income. No new stores, no new products, No marketing campaign. Just the price went up and 93% of members paid it without blinking. Let's talk about the $1.50 hot dog combo, because it is the perfect symbol of everything Costco is doing and why most companies cannot understand it. Since 1985, 40 years ago, you have been able to walk into any Costco in America and buy a hot dog and a soda for $1.50. If that price had tracked with inflation since 1985, it would cost you about $4.40 today. Instead, $1.50. In 2013, then CEO Craig Jelinek went to Costco founder Jim Sinegal and told him they needed to raise the price on the hot dog. Sinegal's response, now legendary inside the company: "If you raise the effing hot dog, I will kill you. Figure it out." So they figured it out. They switched drink vendors. They built their own hot dog production facilities. They ate the cost, and the hot dog stayed at $1.50. Why? Why would a company obsess over a $1.50 item when they're moving $250 billion in merchandise? Because the hot dog is not a hot dog, it is a message. Every time someone walks past that $1.50 sign, they are being told, this place is different. This place is not trying to squeeze every dollar out of you. This place has decided something costs $1.50 and means it. The hot dog builds trust. Trust sells memberships. Memberships are the business. The rotisserie chicken is the same story, taken to a more expensive extreme. At $4.99, a price that has not changed since 2009, Costco loses between $30 and $40 million every single year on rotisserie chickens. Every year, on purpose. An average chicken costs about $6 to $7 to produce. They sell it for $4.99. The math does not work. The strategy absolutely does. The chicken is placed at the back of the store, which means every person who wants that $4.99 chicken has to walk past literally thousands of other things they might also want. That detour through the store is worth more than the $2 Costco loses on the bird. In 2019, Costco invested $450 million to build their own chicken processing facility in Nebraska, a facility that produces 2 million chickens a week, specifically to keep the price at $4.99. They lost tens of millions of dollars on the chicken, so they spent $450 million to lose tens of millions of dollars more efficiently. That is not a mistake. That is a company that understands exactly what it is selling. Here is where this gets personal. You, as a Costco member, are participating in a system that is, unusually for American retail, actually designed to benefit you. The reason Costco's merchandise margins are 3% is not an accident or a failure. It is a deliberate policy enforced at the highest levels of the company. Costco famously caps the markup on any item at 14%, and for most items the markup is far lower. Sinegal used to walk the floor personally to make sure nothing was priced above that cap. Compare that to a typical department store where markups of 50 to 300% are completely normal. The result is that the Costco model, once it reaches scale, creates something close to genuine value for the consumer. You are paying $65 or $130 a year. You are shopping in a warehouse with concrete floors and no salespeople. You are buying 48 rolls of paper towels at a time. And in exchange, you are getting prices that would be genuinely difficult to match anywhere else at the same quality level. This is not charity. Costco's shareholders have done extremely well. The stock has returned roughly 20% annually over the last decade. Jeff Brotman and Jim Sinegal became billionaires. But the model works because member value and shareholder value are, at Costco, the same thing. More value for the member means higher renewal rates. Higher renewal rates mean more predictable membership revenue. More predictable membership revenue means a stock that trades at 50 times earnings. Costco's price-to-earnings ratio, the amount investors pay for every dollar of earnings, is typically around 50. Walmart's is around 35. Target's is around 20. Investors pay more for Costco because the business is more predictable. The business is more predictable because the members keep renewing. The members keep renewing because they feel like they're getting a deal. The entire financial architecture of a $250 billion company runs through the goodwill of someone buying a $1.50 hot dog. You might be wondering why every other retailer hasn't just done this exact same thing. The answer is timing, culture, and a particular kind of restraint that publicly traded companies find almost physically painful. Amazon tried. Amazon Prime is the most successful copycat of the Costco membership model in retail history. And it works because Amazon built it early, before it had to deliver quarterly earnings growth while simultaneously charging less for everything it sold. Walmart tried. Sam's Club exists. Sam's Club has a 90% renewal rate and 700 locations. It is genuinely successful. It is also not Costco, because Walmart cannot resist the temptation to squeeze more margin from its merchandise. The culture is different. Target tried variations. They have not broken through. The reason is that the Costco model requires a company to look, for years, like it is leaving money on the table. The merchandise margins are thin by design. The loss leaders lose money by design. The hot dog is $1.50 by executive decree. Every public company has analysts asking why margins aren't higher. The Costco answer, essentially, is because we promised our members they wouldn't be. Jim Sinegal used to say that retail is a business of details. What he built was something more specific. A business where the details were all pointed in the same direction. The membership fee pays for everything. The merchandise proves the fee is worth it. The hot dog reminds you of the deal every time you're hungry. It sounds simple. 40 years and one serious competitor have proven it isn't. So why does Costco lose money every time you shop there? It doesn't, exactly. But the money it makes has almost nothing to do with what you put in the cart. You paid $65 to walk through the door. The rotisserie chicken, the hot dog, the aggressive margins on every product. Those are the company telling you the $65 was worth it. Because if you believe the $65 was worth it, you pay it again next year, and the year after that. For statistically, the next 10 years, 137 million people are currently renewing that bet at a 93% rate. The warehouse is enormous. The margins are razor thin. The business model is, quietly, one of the most elegant constructions in the history of American retail. And it all depends on whether you feel like you got a deal on a $1.50 hot dog. You probably did. That was the point.